This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This lecture is the second lecture on chapter 26 of the free paper F2 lecture notes, where we're looking at financial performance measurement. In the first lecture, we went through the profitability measures. Obviously, we want the business to be more profitable. In this lecture, we're going to go through the liquidity measures. And what we're concerned about here primarily is, has the company got enough cash in the short term to be able to pay its bills? Because even if the company's profitable, if the company's running out of cash, then potentially they could have huge problems. And so we need to keep a check on it. And the liquidity measures, the first one of the most important of all, is what we call the current ratio. And again, they're all written in the notes, but still, it's the current assets divided by the current liabilities. This isn't as a percent, it's as a number. And so, just check with the figures. In 2007, from the statement of financial position, the current assets were 2314, and further down the current liabilities were 965. And so as a ratio, 2.40. In 2006, what was it? Current assets were 1679. Current liabilities were 704. And so last year the ratio was 2.38. So here it's hardly changed. However, this is one of the few ratios which means something on its own. Normally it's a question of comparing. Are we better than last year or worse? Or are we better than other companies or worse? This one, from year to year, it's hardly changed, obviously. But this has to be more than one. That surely, if ever the current ratio became less than 1, or started to get very close to 1, then we'd be very, very scared. Because, this company owes 965 in the short term. If current assets were only 960 in the short term, then how on earth are they going to pay the bills? They've got problems. Here, no, doesn't appear to be any problem at all. They've got 2,300 there. They're going to have no problem paying in the short term the 965. The only thing there, though, is when we talk about the short term, just look at the statement of financial position again. The company owes 965, and it's short term. They'll probably have to pay that in a month or so. They've got cash. The cash is immediately available, no problem. The receivables, well, it'll take a while to get that money in, but hopefully we'll have got the cash in by the time we need to pay the cash for the current liabilities. The only thing is, though, inventory, that before we can get the cash, we're first of all going to have to sell the inventory, which may take a while. And then, assuming we sell it on credit, it will then take a while before we actually receive the cash. So it's likely to take a lot longer to get that cash in, and yet we've still got to pay these liabilities. And so the next ratio, the quick ratio, or the other name is the acid test ratio. We say, well, in the very short term, let's ignore the inventory. It's the current assets minus inventory. divided by current liabilities. So it's just like the current ratio, but for the reasons I just explained, we ignore the inventory. So what was it in 2007? The total is 2314, but if we take out the inventory, it's 1308 over current liabilities 965. 1.36. In 2006, 1679, but take out the inventories of 871, leaves us with 808. Liabilities 704. 1.15. Well, if you've understood a single word I'm saying, you'll appreciate this is always going to be lower than the current ratio. You'd always expect it to be closer to 1, and even if it was slightly below 1, maybe we wouldn't panic. Here, well, it seems okay, it has improved a bit. They should have no problem paying the liabilities. Moving on, the next one's a bit more interesting, and in fact I'm going to slightly change the order just to, I think, make it even more obvious. First of all, I say I'm changing the order, so average collection period or receivables days. And what this is an estimate of how many days it's taking us to collect money from our customers. And as you can see, we take our receivables, the old word used to be debtors, divided by the total sales or the revenue. And we multiply by 365 because there are 365 days in a year. So see what I mean with 2007? Our receivables were owed 948. Our total sales are 7180. And so I'm not going to write down a percent. Our receivables are that percent of everything we sell during the year, which does mean that we appear to be taking about 48 days to collect in the money. Now, before I say any more about it, let's just read the previous year. The previous year, receivables were 708, the sales were 5435, and so last year it seemed as though we were taking 47.5, effectively the same, 48 days. However, a few things about that. First of all, strictly, it should be sales revenue on credit. You know, it may mean maybe that some of those sales are for cash and only some are on credit. It depends what information you're given in the exam. Usually, you're only likely to be given total sales, and so you have no choice but to do what I've done. Secondly, do check, although we would usually use 365 days, if the question on occasion might say assume 360 days in a year, in which case you assume 360. Secondly, or thirdly, although we want that, if you think about it, we want that to be as low as possible. You know, the faster they're collecting the money in, the better. You can't really say whether 48 days is good or bad. You'd really need to compare with similar companies because different types of company are almost forced to give different periods of credit. Finally, one problem to be aware of here is that we're using the end of year receivables with compared to the sales for the year. And it could be that at the end of the year, the receivables are unusually high, perhaps we've just done a lot of invoicing, or maybe they're unusually low. It could be very distorted. It would make more sense to use average receivables, but it's extremely unlikely you'd have the information available to do that. So if you got the chance ever, do be aware it could be misleading. Let's carry on though. In exactly the same sort of way, we can look at the average payment period. Or payables days. Which is looking to see how long we take to pay our payables, our creditors. How long are we delaying payment for? And so it's the payables divided by the purchases, again times 365. Now here again, you're going to have to use the information available because strictly it should be the purchases on credit. But you're very unlikely to be told. You see, all we're told here is cost of sales. Well, first of all, that's not the same as purchases. There can be other costs involved, and it's not necessarily all on credit. If you're told purchases on credit, use it. More likely, all you'll know is cost of sales. I'm afraid you're going to have no choice. Certainly, the payables at the end of the year are 965. If we use cost of sales, in the absence of anything else, it's 5385, which gives us good heavens, it's 600 days. Let me try again. 965 divided by 5385 times 365. It gives us 65 days. Whereas in 2006, liabilities 704, cost of sales 4212. Uh, 61 days. Now a couple of things here. In some ways, the longer this is, the better. Surely it makes sense to delay payment as long as you can. Although, be careful, if it gets ridiculous, if we're taking too long to pay people, the danger is they'll stop supplying us. And of course, if they stop supplying us, then we've got terrible problems. So, it's trying to delay payment, but without getting extreme. Here it's not changed much, there's not much we can make. One other thing that could be worth looking at is these two together. Does it not make sense that a company should want to get money in from customers at least as quickly as the time they're taking to pay suppliers? And here they are doing. Customers, they're getting the money in 48 days and they're taking 65 to pay the suppliers. If it was the other way around, then I'd start to be worried. Finally, the one I left till the end, if we jump back, inventory days, is looking at how many days our inventories are likely to last for. It's the inventory over the cost of sales. Times 365. So in 2007, our inventories were 1,006. Our cost of sales, 5385. which is 68 days. Before I make any comment, let's just look at the previous year. 871 inventory, cost of sales 4212. At 75 days. Now again, it's difficult to say too much here because it so much depends on the type of business. But you'd really normally want to keep that as low as you could. You know, you need some inventory so that you're able to supply customers, that you don't run out of things. But the danger, if it gets too high, you know, here, 68 days, it's going to take over 2 months to sell it. The danger is, if it's too high, that you might end up never selling it. It might become obsolete or damaged, out of date. So we do want to keep that reasonably low. This does look rather high, but it does depend on the type of business. All right, that's liquidity. There is one more area, gearing or risk. But rather than have a separate lecture, because it's only quick here, I'll do it straight away. There's something called the gearing ratio. Which is the non-current liabilities over the share capital plus reserves. Well, what's that for 2007? Non-current liabilities are 500, share capital is 2190. Which is 22.8%. In 2006, 400, 1401. Uh, 28.6%. Now, there's not much you can say here, to be honest. Later exams, particularly paper F9, you could be asked to write essays about this. But the reason we are interested is that the more long-term borrowing there is, the more risk there is to shareholders. Higher gearing more risky for shareholders. And the reason it's more risky is long-term borrowings, you have to pay interest each year. And so the more long-term borrowing, the more interest you have to pay. And interest has to come out of the profits before there's anything left for shareholders. So it means if profits go down a bit, but you've still got to pay a lot of interest, there could end up being nothing left for shareholders. And so that's really all we can say. And in fact, can you add to my note, I doubt it would be relevant, particularly at F2, but something else we could look at a similar thing called the interest cover. An interest cover, it's the profit from operations divided by the interest. Sorry, going on a bit, but this won't take a moment. For our example, in 2007, the profit from operations, the profit before interest and tax, was 790. The interest, I said earlier, finance charge costs as interest, was 50. And so it was 15.8. Whereas in 2006, Profit was 462. The interest was 52. It was 8.9. Now, the reason that's relevant is this. If that figure was very low, let me make up a figure. Just suppose in 2007, the profit was 52 and the interest was 50. $1.04, then if I were a shareholder, I'd actually be very scared, because it means if next year, if profits just went down a tiny bit, then maybe they couldn't pay the interest. And if they couldn't pay the interest, maybe we'd have to close down. Whereas the figures for our question, no problem at all. Last year, the profit was 9 times the interest. This time, it's 16 times the interest. Profit would have to fall an enormous amount next year for us not to be able to afford the interest. And so the lower this is, the more risky. Okay, so there we are. There's a little bit on the last page, but I have effectively mentioned it already. Limitations of ratio analysis. I mentioned it as we're going through. So do have a read on your own and check it makes sense.